some analysis of what's going on there. Clifford Bennett joining us from ACY. Clifford, good to see you.
Hello, Andrew.
It's pretty unbelievable, isn't it, that we arrive at this point so often?
I think it's something like the 68th time we've had a debt ceiling crisis showdown. So, yeah, it's a little bit repetitive. But that is the nature of what this legislation is. It's a debt ceiling. They always hit it. They always have to raise it.
Well, of course, the bone of contention now is the Republicans are saying we're still spending way too much. You need to find ways to cut the budget, which, of course, accelerated considerably during COVID. This one does look as though it's going to go down to the wire. What would happen should they not reach that point at June 1, which is what Treasury Secretary Janet Yellen's pointed out will be that tipping point?
Well, I think what would happen is we get a lot more eyes on our screens, for starters, Andrew. It'd be a very busy time.
Yeah.
But look, I think you would see bond yields go up around the world. Bond prices would drop around the world because there's such an interlocking with US Treasuries that a US default would definitely reset both their bond market and a lot of other bond markets around the world. So it wouldn't just be a US experience, it'd definitely be a global experience.
US dollar?
US dollar, it can be paradoxical. It can rally when the United States is falling apart because some people still think it's a safe haven currency. This could be the straw that breaks the camel's back though. If there was an actual US default which wasn't resolved, what I think could happen is if there's a default, then there's a solution within 3 to 4 days put in place.
Because there would be panic stations then.
Yes, they'd have to do something. So, and they can always print money to keep the government going. But I think that you would see a solution within 3 to 4 days. The Republicans would get their shock and awe that a default occurred, therefore vote for our presidential candidate. And the Democrats would happily agree to almost anything at that point. So I think that's the worst case scenario. But regards to the US dollar, I think I'm reasonably confident 2, 3, 4 years down the track, the US dollar is going to be another 15 to 20% lower. It fell 15 to 20% over the last 12 months against the euro, could certainly do that. In the moment though, the US dollar is likely to be supported by the more likely outcome, because I only put a default at a 25% chance, a more likely outcome of it is resolved, but it may not be resolved on Tuesday. It may require another meeting after that, but it will be resolved in time. I think it's looking more like that now.
Well, and that's one potential crisis. You've still got the banking crisis in the States as well. No one's willing to say that is over. Did you see more issues to come there?
We've chatted a lot on your show, Andrew, about the inflation risk and how strong inflation continues to look in the United States. The problem is the headline might have dropped from 5.0 to 4.9. That's 0.1% in a survey. It means that really headline inflation is sticky. And we know that core inflation is actually re-accelerating in some regards. And on Friday, with that University of Michigan sentiment survey, we also saw that consumers are expecting inflation to be stronger over the 3-year period than previously.
Yeah, and also, moreover, consumer sentiment has plummeted. I guess there's no surprise because, you've got worries about the debt ceiling of the banking system and more broadly where the US economy is heading at the moment.
But consumer sentiment's been down here for a while now and it had a bit of a rally. And so Friday's sort of return to a sharp fall is a major concern because people say, okay, US consumer sentiment, it's the lowest number in 4 or 5 months or whatever it is. No. It's only been here twice before in the entire history of this economic series. The 2 occasions were early 1980s for the economic crisis the United States had then, and during the GFC. The current sentiment levels in the United States, how happy the US consumer is actually twice as bad as it was during the lockdowns from COVID. So if you can imagine the depression that was out there amongst consumers during COVID, the worst of COVID, they're actually twice as negative now as they were then.
But they're still spending.
Well, they're still spending partly because of inflation, but we're seeing a real switch from, sort of exuberant excess luxury items, not so much luxury items because the society is splitting in two. The very wealthy are getting wealthy and the poor and the middle class are getting pushed down. But amongst the bulk of the population, the shopping patterns are very much going more towards essentials now as much as possible.
All right, so as each day passes then, does the Fed's job get more difficult of negotiating that path to a so-called soft landing?
I think so, but I think the Fed is used to that path being difficult. It's been difficult for a little while. I think there's a real chance here that whilst the Fed may pause at the next meeting, the inflation data over the next month that we see coming, that's going to surprise the market in terms of how strong inflation is. And it could spook the Federal Reserve into hiking interest rates at the next meeting and not pausing. If it does pause, it's going to be very loud and clear about maintaining a tightening bias, which the market isn't really fully pricing. And I do believe that even after a pause, inflation showing the characteristics that it is now and possibly re-accelerating, you might have a pause of 2-3 meetings and then the Federal Reserve again hikes interest rates. That's not a great outlook for equities or bonds, in that they've tried to price these massive rate cut expectations that, to be honest, were never going to happen. And the banking crisis is really going to be hit hard by this sort of clinging to hope that they won't have to revalue their bond books to market, that in the meantime the Fed will cut rates, that the market will move back to where they bought their bonds and they won't have these massive losses. But still, Janet Yellen's policy is continuing to drive depositors out of regional banks and into the major banks. So they're still getting squeezed by high bond yields and low bond prices and by depositors withdrawing funds.
All right, so you're decidedly negative on risk assets at this point.
Just a little bit. I'm sort of sell everything America.
Right.
Sell everything America. Maybe you buy the US dollar for a week or two, but otherwise sell property, sell stocks, sell bonds. So yeah, just a little bit bearish.
All right. Clifford, before you go, I wanted to ask your opinion on where we're at locally then. Interesting, we spoke with NAB last hour. They've returned to their call that the cash rate's going to rise to 4.1% by July.
Okay.
Would you agree with that? I mean, they're citing that inflation, it's going to remain above target in near term, which I think is a given. The economy is resilient, overly resilient, and of course we've got that tight labour market.
Yeah, I think if the nature of inflation globally at the moment, as we're seeing globally at the moment, that is far more resilient and firm than many had expected. If that continues to play out in Australia, then I always had a target range of 4.5 to 5.5% for the RBA, knowing who the RBA is, not necessarily saying that's the correct policy. That seems to be where they are headed. They only paused really, well, I won't say, but it might have been a political pause for a certain review process. I think they still need to focus on inflation in their own minds, and that means, yes, I think the NAB could be right and rates could go even higher than that.